This video is brought to you by OKCoin Crypto Exchange, where you can buy, sell, and trade your favorite cryptocurrencies, and you don't have to pay high fees. OKCoin has very low fees, lower than many of the other crypto exchanges in the market. You can also stake your cryptocurrencies and keep 100% of the rewards. There are no fees. Other exchanges charge fees. OKCoin allows you to keep 100% of the rewards. Sign up with OKCoin, link in the description.
Hi, everyone. Welcome back to the Thinking Crypto channel, your home for crypto news and interviews. With me is Caitlin Long, who's the founder and CEO of Avanti Bank and Trust. Caitlin, great to have you on.
Hey, it's great to be back. It's been a little while.
Yeah, for sure. And I want to say, and first and foremost, thank you, because you're always a go-to for me to get information about the market and to dilute and interpret some of the things that are happening. You're always a wealth of information. So thank you so much for what you do.
Thank you.
Now, before we go into Avanti, maybe you can give us a quick overview for those who are new to the market listening. They don't know what Avanti is. Can you give us a quick overview there, and we'll talk about what's new?
Sure. The natural instinct, of course, of a lot of folks in crypto is, why do we need a bank? Because aren't we trying to get away from the banking industry and try to create something that's better? And the answer is, you still need to have a pathway for fiat money to move into the crypto system and back. There are a lot of people who obviously trade back and forth, but I do suspect that most of the flows will be more towards crypto rather than away from it and back into fiat. And I've said many times, and I always give credit to Ryan Selkis at Masari, who first raised this point in almost 2 years ago, and it's still true today, that one of the single points of failure in this industry is US dollar banking services. There's only about $80 billion of deposit capacity for a market that, as of this morning, is $2.2 trillion in asset value. Now, of course, the market is global, whereas the US dollar deposits are US, but of course, the dollar is still the world's reserve currency. It is still by far the most demanded currency in the world by regular users. And I think it's fascinating that the entire stablecoin market developed as a truly free market, and the currency for stablecoins that the users demanded in 98% of the cases of outstanding stablecoins is US dollars. So that speaks volumes. And so that US dollar deposit capacity constraint, because there are so few banks that service crypto, is an issue. And we're trying to solve that. If we go back to, why did Wyoming create a new type of bank charter? The whole reason is because the traditional banking industry didn't want to service our industry. And if you peel the layers of the onion back onto why, it's because the regulators in Washington, D.C. were considering the banks that are servicing crypto higher risk. And that is indeed still true today. And certain banks like Silvergate and Signature and Metropolitan just took those risks on. They take a ding in what's called their CAMEL score, probably pay higher FDIC insurance premiums. There are lots of details over the risk assessments with regard to how the banks can interact with the Fed. And by servicing crypto, the banks are saying, all right, I'm looking at this industry as a primary growth market, and I'm willing to basically have a disadvantage in those risk assessments relative to where other banks that are servicing other industries. And so this is why you've seen a very small number of banks pretty much specialize in servicing crypto. But every one of us knows or has directly been affected by someone losing a bank account along the way. And in many cases, it's been multiple companies have been debanked multiple times. And, it's the risk issue, but it's also just, the compliance issues. Most banks just didn't understand this, thought it was temporary. A lot of the boomers thought they could retire before it would become meaningful, right? And that they could just ignore it. And It's happened so much faster than a lot of us thought in many ways. And the banks just didn't spend the time and money and effort to understand the compliance requirements that are necessary in order to comply with US laws, whether you agree with them or not. They are the laws, so you have to comply with them if you're a bank. And you know, crypto is very different than traditional banking in terms of compliance. It raises all kinds of new issues, not, I think, in terms of the type of users per se, but more in terms of the, how do you prove that you've complied with things like the travel rule, which the banks have been complying with for years. And it's just so easy in the banking system to do that because the systems have been set up for that compliance. But of course, you know, Satoshi Nakamoto wasn't thinking about complying with the travel rule when he set up Bitcoin.
Yeah, absolutely. So you were certainly ahead of the curve in launching Avanti, and obviously you're providing banking services to crypto companies. Are you also, by any chance, custodying assets, crypto assets, and things like that?
Well, Avanti's not launched yet. To be clear, we got a bank charter almost a year ago. Right. It was a year ago this month. So why haven't we launched yet? We're waiting for approval from the Federal Reserve. We do have the ability to launch without that, but there are lots of reasons why we want to launch with it. We're working with the Federal Reserve. Again, this is the cognitive dissonance. I'm a laser-eyed Bitcoiner, and at the same time, working with the Federal Reserve. And I don't see that as a contradiction at all, because this industry needs its US dollar services, as we talked about earlier, and it's really deposit constrained. And a lot of people in this industry were losing accounts. A lot of legitimate people and legitimate businesses, non-criminals, were losing their US dollar access for the reasons that we talked about earlier, right? So that was the problem we were trying to solve. It's what has happened. What has not happened yet is that a crypto native company has not gotten access to bank at the Fed directly. And that is what Avanti is leading the charge on. And it's a long process, and it's definitely taken more time than we anticipated, but obviously everyone in this industry is caught up in everything that's going on in Washington, D.C. right now, which I'm sure you're going to want to talk about as well. So Avanti's not launched, but we will be soon. Stay tuned. When we have some additional information about timing, we'll let the world know.
That is awesome. The fact that you're working with the Fed, and I love that you brought up the points. Like, we still need these crypto companies working capital. They need liquidity. They
need to pay their employees in dollars. You need to, even if the employees want to get paid in crypto, they still need to pay their vendors in dollars and their taxes in dollars, et cetera. Yeah. Wow.
Now, when you say you're working with the Fed, is it to become FDIC insured? Is that kind of some of the benefits?
No. The Fed and the FDIC are two different entities. They work together, but they're entirely different entities. And if we go back into the history, one of the reasons, what I referred to earlier, the CAMEL score and the risk assessments, the FDIC insurance premiums, those are all risk-based. And one of the things that, like it or not, is a factor in those risk scores is reputation risk. And then, of course, compliance risk, right? It's so easy for the regulators to hit our industry as being high risk from a reputation perspective. And because the compliance is more complex, the risks go up. That's why you saw a few banks specialize in the industry, and most banks decide that they're just not serving anyone connected to it at all. So that's the FDIC. And the FDIC really was the one that just did not want to touch crypto. Of the different bank regulatory agencies, of which there are several, the FDIC has been and still is the most reticent, the most cautious on crypto. And so we're dealing with the Federal Reserve now. This is probably more detail than you need, but here's a really high level primer of how the banking system works in the United States. We've got two-tiered, it's called a dual banking system, not two-tiered. It's because all the banks are really equal. There's a perception that federally chartered banks have a better reputation than state chartered banks, but that's not the case because they actually are on equal footing. The vast majority, more than 80% of the banks in the United States are chartered by states. And then the remaining 20%-ish are chartered by the National Bank Chartering Agency, the OCC. Now, the FDIC is a third player that comes in and provides insurance for consumers, and it's only on US dollars. And then the Federal Reserve, of course, operates the payment systems and also is a bank regulator as well. If you're a state bank, you choose between the FDIC and the Federal Reserve to be your federal regulator, and Avanti chose the Federal Reserve. And it's obvious why, right? I mean, the things we're working on have big connectivity to the payment systems, and that's why we're spending a lot of time with the Federal Reserve, and we're waiting a little bit longer to see if we can get direct access to the payment system. That's the prize, and no crypto native company has gotten that yet. Why does that matter? We control our own destiny with regard to our regulators. It's our own fault if something goes wrong, as opposed to some third party that may not understand our business. And the other is, B is, more importantly, we want to be able to offer this market something that doesn't exist right now, which is the ability to settle a Bitcoin transaction against a US dollar simultaneously. It doesn't exist right now. You can do that at some banks, but what you're getting is a cleared US dollar, not a final settled US dollar. So what that means is you've got a counterparty risk to that bank. And I've been told by a number of players in this industry, given that the banks in this industry are fairly small, the banks that service this industry are fairly small in general. JP Morgan will service a couple of the biggest players, but that's it. Otherwise, we're dealing with fairly small banks. And you've got some traders that are leaving billions of dollars in dollar deposits overnight at banks that may not actually be creditworthy. They just don't know. And so that's one of the biggest concerns. And we aim to be able to not have especially the big institutional traders not have to carry that counterparty risk, because you can get a legal final settled dollar simultaneously against a Bitcoin. But also Avanti's different because we're a non-lending bank. And so the counterparty credit exposure is definitely going to be different than a traditional bank that lends and tries to do maturity transformation. And so that's where you get more credit risk in your counterparty. And Avanti by design is designed not to have that, so that we can offer that settlement finality I just talked about. It doesn't exist in the market today. It takes a lot of risk off the table for this industry. And ultimately, one of the biggest reasons it takes risk off the table for this industry is that US dollars, as we all painfully know, settle slowly. And merchants understand that those dollar payments can be reversed. Certainly if there's a credit card transaction, but even an ACH transaction can be reversed for up to 2 years later. I mean, once you transact in Bitcoin, it's done, right? You darn well better make sure that you're sending it to the right address, because if it goes to somebody else, you're not going to get it back. No. So the very different settlement characteristics between US dollars and Bitcoin in terms of timing and finality of settlement are what create an enormous amount of risk that has to be really carefully managed. And what we're trying to do is take that off the table for customers.
That's amazing. And the fact that you're working with the Fed and this solution that you're looking to bring to the table, I mean, is going to be game changing. So I'm excited for that, to see that go live. Since we're talking, what's that? You said it's still early.
So are we.
Let's talk about Wyoming, because you guys being certainly leaders in the United States as far as states are concerned, in crypto regulations, in clarity. What's new there? I've seen a lot of companies started moving to Wyoming.
Yeah, it's a lot are domiciling. All along since we started back in 2018, a lot of companies started domiciling here. But what's different, to your point, you're starting to hear companies actually moving here. There's a difference between domiciling. Most companies in the US are domiciled in Delaware. But now actually in the crypto industry, I think a majority of US companies are domiciled in Wyoming because our laws are so much friendlier. And frankly, they're just clearer. Right. Delaware just doesn't have any laws related to this. They're resting on their laurels as being the number one state for registering corporations.
Yeah.
But I've heard some very interesting arguments that the corporation is an industrial age organizational form, and that DeFi is the organizational form of the information age. And so Delaware resting on its laurels and not trying to move ahead with this industry, I think they'll look back on this in 10 or 20 years and realize they lost their edge. Whereas Wyoming is grabbing it. We were already in Wyoming. We're the number 2 state for domiciling businesses, because Wyoming is the state where the limited liability company form of organization was invented in 1977. Wow. So we're number 2, but a distant number 2 behind Delaware for new business entity registrations. And now Wyoming has things like the DAO. It's not a true DAO, right? Because why would a true DAO register with the government? But this is a DAO LLC, so the limited liability company. We invented that here, the royal we in Wyoming in 1977. Now, the state of Wyoming in the last legislative session enacted something called a DAO LLC, which is a hybrid because there is a human being involved. There has to be a member of an LLC. There has to be a registered agent when the legal entity gets created, but it can be totally decentralized governance, and you can also have your operating agreement in the form of code. What does that mean? It means that you don't have to put words on a piece of paper. And if there's a legal dispute, then the judge has to be able to enforce the code. So This is really revolutionary in terms of bringing the legal system and the crypto systems together. And you see how it's starting to happen. And I just gave a speech over the weekend to the American College of Trial Lawyers and made the point that that statutes, that law is really just code for an operating system called the Constitution. And, software code is just code for a different operating system. And it's just different languages, but they're both tied to operating systems. It's a really similar concept if you think about it. And are we going to go to the Ethereum folks like to say code is law? Are we going to get there? Eventually, probably yes, but not now. That's going to take a long time. And so we're taking these important steps of starting to get there, where you actually have legal entities that are primarily operating on code and decentralized governance. But obviously, being a limited liability company, there's a human being involved. What does a DAO LLC get in exchange for registering? They get limited liability for the members of the DAO. And if you don't register right now, you don't get limited liability. There is a chance that a rogue judge is going to say everyone in the DAO is jointly liable for everything that happens in the DAO. So people who are more risk averse are naturally going to want to have, some protection of limited liability, which is what registration with Delaware or Wyoming or any other state gives you. It's limited liability. So that's the trade-off. And I think right now that's a fair trade, especially making that first step into these new organizational forms for the information age.
It's amazing what you guys are doing there. And I hope other states, to your point of like Delaware, sort of start moving in that direction as well. Now, let's talk about US crypto regulations. There's a lot to go through here. So
yeah. Sure.
The SEC, there's stablecoins, there's Coinbase, bank charges, infrastructure bill. Before we get into each individual segment, maybe you can give us the state of the union on what is going on, because even myself, I get confused. I'm like, is this political grandstanding? I see Republicans, pushing for clarity. I see Dems doing different things, and I don't want to get political, but there is bipartisan support. It just seems like it's crazy. I don't know what to make.
Yeah, it's not political. We've seen it in Wyoming. The Democratic Party happens to be the minority party in Wyoming, and the Democratic leader of the Senate is actually the main leader of the blockchain efforts in Wyoming right now. So it started with a Republican. It's now, the baton has been passed to a Democrat, and he's just as powerful. So it's so interesting in our little microcosm of the world. It's not bipartisan. And then when you look at what happened with the infrastructure bill in DC, where the whole crypto industry woke up and decided simultaneously, we've got to actually get involved in Congress because they tried to slip a fast one through the infrastructure bill, and they may still do that, right? We lost in the Senate, but we woke up collectively as an industry that we needed to pay attention to these things, and that like other industries, I saw yesterday, Facebook is the #1 spending business in the United States on lobbying. They spend more apparently than the defense contractors combined. And yeah, that's I haven't independently verified that, but I heard that on the news yesterday. And
I'm gonna be surprised.
we in the crypto industry aren't doing that, right? And so, but I guarantee that the anti-crypto folks, most especially the big banks, are. So now we've awakened, but we have something that the big banks don't have. They have money and they have organization. We have people. We have a decentralized group of, probably in the United States, 50, 60 million cyber hornets that own crypto, and most of whom are motivated to make sure that that asset value is protected and isn't taken away by regulations. So now all of a sudden, a lot of folks got involved with Washington, D.C. In many cases, you saw on crypto Twitter for the first time ever.
Yeah.
So we've shown ourselves to be powerful. But right now we're not winning. I got to say, we're not losing because it's not over yet. But boy, we're going to have to get organized again when the infrastructure bill does come up for a vote. There's a lot going on behind the scenes. There's been, from what I've heard in the DC contacts, an unbelievable amount of lobbyists being hired by this industry in the last month. And, it's because of, as you pointed out, what's going on with Coinbase, what's going on with BlockFi, what's going on with the president's working group, in addition to the infrastructure bill. There's just a lot. But that's the federal story. And it is bipartisan. We saw with, by the way, just to close the bipartisan loop, we saw Senator Ron Wyden and Senator Cynthia Lummis, from the progressive wing of the Democratic Party to the more libertarian wing of the Republican Party, come together on something. And it may be the only thing that they've ever agreed upon, for all I know, because they're unlikely bedfellows. But sure enough, they came together and agreed upon it. And long story short, they succeeded in delaying the vote in the Senate on the infrastructure bill for sure. And they are working behind the scenes together to try to fix the infrastructure bill. So it just goes to show you, it just is not a partisan issue. It's it's a bipartisan one. But before we close the point on regulation, we do have to talk about the states, and I do have to give my hats off to a number of other states who are following in Wyoming's footsteps. Arkansas, Nebraska, and Texas have all early adopted a reform similar to Wyoming's, which clarifies what crypto assets are under commercial law, so that if there's a dispute, and of course we're starting to see a lot more litigation than we ever have in this industry as asset values go up and you get less sophisticated people who come in who are not naturally thinking caveat emptorum, just doing something experimental, and if there are losses, we lick our wounds and move on. Now we're seeing plaintiffs' lawyers come in and get involved, and you don't have the clarification under the statutes as to what crypto actually is. And so those three states, Arkansas, Nebraska, and Texas, early adopted what's called the Uniform Law Commission's draft of Uniform Commercial Code Article 12, just threw a bunch of legal terminology at you. All it does is basically just say that this stuff is property, and say that you actually have title to it under the following circumstances. And if you want to pledge it as collateral, the lender gets what's called a security interest, a lien that they can enforce under the following circumstances, et cetera, et cetera. Very important foundational stuff that's very boring to most people, but when it doesn't happen and you get into a dispute, then it's a problem. So you want this to be clarified, and I've got to give a shout out to those states for going ahead and doing so quickly.
So to summarize, essentially, it seems to be the need for more advocacy groups, more lobbying, and those groups need to educate more members of Congress, because it seems it's in the lap of Congress. We need more folks to get on board with the bipartisan groups that are already moving forward.
Yeah, I think that's right. But, it's not even necessarily hiring the professional lobbyists, the so-called swamp creatures. Some of them embrace that term and others reject it. But, it's not necessarily the case that that's how we need to react as an industry. We are different than the big industry trade associations, right? We're never going to have the money that they do because the banks can throw hundreds of millions of dollars if they want to at Congress in terms of political donations and hiring and paying lobbyists and attack dogs. And believe me, they are, because they're attacking us, and trying to block us, by the way, using various means. But what we are is decentralized. And so basically what I think every single congressperson realized back during the infrastructure bill debate in the Senate is that they have a lot of crypto owners in their district. And that's how we need to flex our muscles. Just continue to make phone calls, write letters. It does matter. They do pay attention to that stuff. And especially if we're really vocal at important times, then it does matter. And so I've seen this in other states. In California, twice I've been asked to help rally the troops using my social media platform to vote down bad bills in California, and it's worked over the last couple of years. We as an industry have succeeded because we talk to each other on social media platforms, and we're not afraid when it comes time to countering the legal threats to our crypto wealth. We're not afraid to get involved, and that's indeed, I think we're going to be called upon to do that more and more. But it's not necessarily that we need to pay necessarily true that we need to pay lobbyists. We just need to get active individually. It matters.
Yeah, absolutely. Now, there's an interesting dichotomy. On one hand, I see these big banks, Goldman Sachs, JP Morgan, and so forth. They are launching Bitcoin wealth funds and the ability for their wealthy clients to invest. On the other hand, I see that they have their laser focus on stable coins and lending, a la Coinbase trying to block it. So that's kind of the thing that's going on there? Okay, with maybe some of the assets and the fact that people can speculate and invest in it, but the things that would take money away from them, the lending and stable coins, they don't like. Is that kind of what's happening?
Well, they don't want the upstarts doing any of it. That's been my experience, right? And in Avanti's case, we are subjecting ourselves to the exact same rules and regulations as the banks. And yet they still don't want us to get access. What does that tell you? It means they don't want any competition, and they're using their various gatekeeping means as well as their influence over policymakers in Washington. And that just the fact that they're all on, proverbial speed dial, they know each other because they've been working together for years, right? And we don't have that longevity of relationships, right? So that's what they're doing. And so I wouldn't make the distinction between Bitcoin versus stable coins. What they really want to do is corner the market and dominate it. I think what they'd like to do is do what they did to other commodities. And one of the things that I'm concerned about, I've been very outspoken against a number of the things that have been happening in the crypto industries, particularly related to lending. Because I've been since 2016, when I started writing for Forbes.com, when Bakkt announced that it was forming, I said, oh no, this is Wall Street coming after crypto. Right. And they're going to do the same thing that they did to gold and other commodities. They're going to create more paper claims to the asset than there are real assets. And by the way, it wasn't just the Wall Street firms doing that. It's been mostly, crypto firms doing that. And if you look generally, they're run by former Wall Street traders, right? They're applying some of this very same bad types of financialization to Bitcoin and other crypto that they apply to any other asset. They look at it as just another asset they can trade. And you know what? They know how to trade these assets and make a lot of money at it. But I think Bitcoin is going to win in the end because it's Trace Mayer used to call it the apex predator of finance. And I think he's right. And the reason is because there are only 21 million of them. And when the collateral calls come, all the paper Bitcoin that people think they own, that's the real thing, is not. It's a claim. It's an IOU. It's a claim on an intermediary. It's not the real thing. The only way, as we all know, to own your real Bitcoin is not your keys, not your coins. If you self-custody your Bitcoin, or in the case, once the Wyoming banks get going, if you custody at a custody bank using a bailment legal structure where you retain legal title,
Wow.
even though you've turned management of the keys over to a custodian. The custodian is just a service provider the same way as a coat check or a valet parking garage. You don't turn the title to your car over when you hand them your keys. You just give them temporary possession of your car and the ability to do one thing with it, which is go park it in the garage. And when you want it back, you get it back. And that's the way the Wyoming legal structure works. So if you're not going to hold on to your keys, use a Wyoming custodian, because at least you still have legal title. But anyway, that's the way to fight back against these types of unhealthy financialization that suppress the Bitcoin price. And oh boy, is it happening in spades right now. And it's, some of it is crypto people themselves. But again, go look at who's running the intermediaries. If you see the background of the folks running the intermediaries, I'm not singling anyone out and saying this, if they were a Wall Street trader and then they started a crypto firm, that says something. I was not a trader on Wall Street, by the way. I was a banker, an investment banker. Big difference. Yeah.
Now, you brought up there the paperback assets, or whatever you want to call it, and how they're manipulated gold and silver and so forth. We're hearing, and Gary Gensler said he's in favor of a Bitcoin futures ETF versus physically backed ETF. So, everybody's in anticipation of an ETF getting approved in the United States. So, but do you think the futures ETF is not going to be a good thing?
Well, so I did write about this for Forbes back in 2016 as well. One of the challenges with derivatives, of which futures are one type, is that can create more paper claims to the asset than there are real underlying assets. Now, in the United States, the futures markets are predominantly cash settled. LedgerX, I think, definitely does offer Bitcoin settled futures in the actual underlying. Backed, I believe, does as well. Yeah. Now, if it's cash settled futures, does that have an impact on the underlying price? There's a big debate over whether that's true or not, that long predates Bitcoin and Bitcoin futures. But if it's cash settled, the collateral is always cash, and all you're doing is basically betting on the price movement purely. But if it's physical settled, you're trying to get the actual underlying. Somebody is actually pledging the underlying, and that is going to change hands if the contract matures in the money, or in the case of an option. But these derivatives definitely have an impact on the price. I have argued that the so-called physical settled derivatives, the ones that actually settle in Bitcoin, have a much bigger impact on the price than the ones that just settle in cash. Or if you're talking about offshore exchanges, typically the futures, the 100-to-1 futures contracts typically settle in a stable coin as the collateral. But once you start actually getting involved with the actual underlying collateral, now what you're doing is putting leverage on that underlying collateral, and anything that goes above 1-to-1 leverage. Again, there were 125-to-1 futures contracts. Anything that goes above 1-to-1 leverage is what Mises would refer to as commodity circulation credit. Go read your Mises. Mises made the distinction between different types of leverage, and it is so applicable to what we're talking about. There's a good type of leverage, which is healthy, and that is called commodity credit in his parlance. And there's the unhealthy, bad type of leverage, bad financialization, which is circulation credit. And pretty much everything I'm seeing in these futures markets basically everything that goes above 1-to-1 is circulation credit. And anything that goes up to 1-to-1 is commodity credit. What's the difference? Why does that matter? Commodity credit you're basically somebody who owns the real underlying, who has saved their asset value in that asset, saved their wealth in that asset. Someone is lending it out and just providing liquidity services to the marketplace. There's value to that, and that's legit. And it doesn't create malinvestment. It doesn't cause the price to swing. But if you're going above 1-to-1, now you're in the zip code of circulation credit. And this is where, unless you've done your real Mises reading, you look at it and say, gosh, sure, I'll take a flyer. I'll go up, 3-to-1 on Bitcoin, or even 100-to-1 on Bitcoin. But what you're doing when you do that is facilitating the bad type of financialization, which is creating more paper claims to Bitcoin than there is the real underlying. And at some point, the system is going to fight back. And this is where, going back to Trace a few years ago, talking about this very issue, it just gives the hodlers an opportunity to buy Bitcoin at a cheaper price, because it's suppressing the price by artificial supply, satisfying real demand. But at the end of the day, there are only 21 million Bitcoins. And so when there's a margin call and you've got to settle in the real underlying, that's when the hodlers fight back. And the short squeeze in that scenario is going to be spectacular. There are a lot of people who have been talking about this in gold and silver and other commodity markets for years. When the commodity ETFs came on board, and you started to see commodity funds, and they were investing in futures as opposed to investing in the actual underlying, it caused price suppression. Why? Because you were creating all this leverage, all these artificial claims. Now, we have not seen the system fight back, and the real physical limitations on the real underlying oil or gold or silver bite yet. But my argument is that they will bite more painfully in Bitcoin than they do in traditional commodities, because of one simple thing, which is that the vast majority of Bitcoin is owned by individuals, not by Wall Street. Even if you look at the gold market, the vast majority of gold is owned by central banks and bullion banks. What's consistent between central banks and bullion banks? They're both banks. So the banking system in aggregate really does control most of the underlying gold. And that's one of the reasons why we haven't seen this massive short squeeze yet, because they can always lend it to each other. But in Bitcoin, I'm watching the Glassnode data right now. I think it's down to only about 8% of the Bitcoin outstanding is actually owned by intermediaries. In other words, is held on exchanges. That number, of course, fluctuates, but it's probably 95% of the gold. Right now, it's 8% of the Bitcoin is held by intermediaries. And so what that means is, when the short squeeze finally does come in Bitcoin, it's going to be really amazing to watch. And it will take intermediaries down. And I will close this long answer with, I predicted back in 2016 that there will be big banks that fail ultimately, because they don't understand this very thing we just talked about. Yeah. And they'll get themselves leveraged and over their skis. And one of the things that I am trying to do in speaking out, in working with the traditional regulators and speaking out against letting these big leveraged financial institutions get in and start leveraging Bitcoin this way, it actually does increase a lot of their default risk, whether they know it or not. And it does put the traditional financial system stability at risk. And they just shouldn't do it. If they do it, they need to do it in a non-leveraged, ring-fenced way.
Now, do you think we could see a Bitcoin ETF approved this quarter? Once again, high probability maybe of it happening. And but what does your gut say?
I have no idea. I mean, obviously, Gary Gensler, a month ago said that he is considering. He put out the requirements that he would look for in approving an ETF, and it's futures based. It's not actual Bitcoin based. And so I think if you take him at his word, that it's pretty clear that at some point he's going to approve that. And that's the carrot that that he's been dangling in front of this industry. But again, I seem to be a minority voice in saying this is a double-edged sword. I am not excited about a Bitcoin ETF being approved. Will it increase liquidity? Will it bring in new buyers? Yes, but it opens up all the can of worms I just talked about creating more paper claims to Bitcoin than there are real Bitcoin, and kicking the price around and suppressing it overall relative to where it otherwise would have been had we not had an ETF. We don't need more Bitcoin liquidity. We really don't. And I would go back to Nick Szabo's point at Bitcoin 2021. To me, that's the most significant thing I've heard articulated this year at all in this industry. It was Nick Szabo saying that liquidity is a nice to have, but it is not a must have for these markets. And those who want Bitcoin ETFs are trying to, again, kowtow to the traders and the speculators. And I welcome all of them into the industry as long as they don't, recreate the problems of Wall Street, where you're creating more paper claims to Bitcoin than there are real Bitcoin. And unfortunately, that's what we're actually seeing happen. It's already here, even though the big Wall Street firms haven't come in yet, but they've got big balance sheets and they can create a much bigger pool of claims, paper claims to Bitcoin relative to the underlying. They're going to be much more leveraged, I think, than the existing players that are crypto native, who at least understand some of these things, even if they're rolling the dice on taking the risk. So this is a double-edged sword, and I won't be cheering it if it does happen.
And I'm absolutely agreeing with you. But if we were to get a physically settled, you wouldn't be as worried, right? I'm assuming.
As long as it's only 1-to-1, again, going up 1-to-1. But here's the problem. If you go and read the prospectuses of any ETF, just grab any of them off the SEC's Edgar website, what you're going to see is that the market makers have the ability to go naked in order to facilitate liquidity. Every single ETF market maker is bestowed by the SEC with the ability to create a naked short. Why? Because they know that the timing, especially because ETFs settle trade date plus 2 days in most cases, right? And so you're trying to manage the inflows of US dollars, which also don't settle very fast. And then the underlying asset, Bitcoin, which does settle fast. Now the futures also settle fast, right? But so I just laid out for you, you've got a bunch of things that the ETF market maker is trying to manage where the timing of settlement is different. Okay. And so the SEC said, well, we're not going to make them gross settle everything, these ETF market makers. We're going to let them from time to time take naked positions up to, say, 5 or 10% of the size of the fund, just to facilitate market liquidity so that we have a continuous market. Okay. Those who care about property rights look at that and say, are you kidding? But this is the way the ETF market works, folks. This is not unique to Bitcoin. Go look at any ETF prospectus. You're going to see that the market makers have the ability to go naked short. And, they do that again to facilitate these timing differences. And it's really just, I've talked about this before in the context of the Dole Food case in Delaware. It's bad system design, just slow settlement. And it's all just designed to reflect the reality that Wall Street's bookkeeping systems are never in sync with each other because they all settle on different settlement cycles. And so you got to have some fault tolerance in the system somewhere. That's the theory behind it. And like so many policies, it has a good intention, but the actual reality is that, of course, the trading desks know how to arbitrage that. And believe me, they're making money every little extra penny they can from the fact that they're allowed to go naked shorts. So now all of a sudden you've got these naked shorts with the market makers coming in. So we're going to have all this new money coming in through the futures market, but you're also going to have the ability for the market makers to go naked short. So just again, this is a double-edged sword, folks. This is not something I'm going to be cheering. I'm going to say, well, hey, that's interesting, and I'll also say, gee, it's too bad if it happens the way that I think it's going to happen, because we're going to go beyond 1-to-1 leverage. Up to 1-to-1 leverage is fine. Beyond 1-to-1 leverage, now you're in circulation credit world, And that has a suppressing impact on the price relative to what it otherwise would have been.
Yeah, I mean, you brought up just a great point. We don't want to repeat the same mistakes that we have with traditional financial assets in the world and bring it into crypto.
Yep.
So we'll see how things pan out, and hopefully, Bitcoin, it has found a way to break out of any things that have happened to it historically, that it can do the same.
Apex predator, you know, it's proven itself again and again. And I think a lot of people probably scratch their head and say, what are you talking about? But you know, don't blame don't listen to me. Just look at what Bitcoin has done and everything that has been thrown at it, that folks have tried to use to kill it or to harm it, including some from within our own industry, not just from outside. And look at what Bitcoin's done. It is an unbelievably resilient system.
I want to talk, since we were talking about a Bitcoin ETF, Gary Gensler, the SEC. I don't know what this is all about, but he's looking at almost like everything is a security. He won't now even say Bitcoin is not a security.
Right.
And is it, you know, what we talked about earlier, that he is under the influence of the traditional banking world, and or maybe it's more of a power grab because he doesn't want the CFTC to have as much power? You know, what are your thoughts on this?
Yeah, I don't know that it's the you know, that he's been captured, so to speak, by the traditional banks, but I do know that he's got an incentive within the organization to grab power. Every bureaucracy tries to expand its power. This is true of private sector bureaucracies and public sector bureaucracies, so that's not a surprise. But yeah, I think back to your earlier point about everything being a security, that has to do with the structure of the securities law in the United States and the Howey test, which creates the ambiguity. This long predates crypto, right? You know, was the orange grove in the Howey Supreme Court case, were those oranges really securities, right? And the way the Supreme Court defined this, of course, this law was made not by Congress, but by the Supreme Court through a court case. The way the law, the four prongs of the Howey test, the one that is the most ambiguous is investment contracts. And basically everything is a security unless it's exempted. And there's been a lot of litigation around this. In fact, there's been litigation over whether a certificate of deposit at a bank is a security, right? And so the way they carved it out of the securities laws by Congress this time did carve out things like certificates of deposit and say, as long as the financial product was issued by a regulated entity that had a fulsome regulatory regime, then you know, that regulatory regime has jurisdiction over it, right? So the bank regulators have jurisdiction over certificates of deposit. But everything else is a security. One of the challenges with that wide-ranging view of securities law, though, is that most of the rest of the world doesn't have it. So, and so I'll use the Ripple example as one. In the United States, there is a legitimate question whether crypto ends up in that investment contract bucket, but where securities are not defined to be investment contracts in other countries, there's not that same question, right? And so you're actually seeing, you know, when the SEC came out with the lawsuit against Ripple, obviously XRP took a big hit, and it's not traded on US exchanges anymore, but it's still trading outside of the US. Why is there such a dichotomy? It comes down to this very question, in my opinion, whether something is an investment contract in the United States, and that puts it in the securities world, but you don't have that investment contract distinction in most of the rest of the world. And as a result, we've got all this ambiguity and just huge differences in the definition of securities across the world.
Yeah, and is the solution, I mean, in your opinion, we just need an updated version of the Howey test 2.0 to cater to digital assets and crypto, because it's a different world. It's not 19 whatever 30 something, right?
Yeah. Well, so Commissioner Hester Peirce has called for that in effect, and there's been a bill introduced in Congress to codify that. Yeah. What I'm hearing, and I'm no expert, I don't want to be on the ground in DC, but I do have to keep my ear to the ground there, given everything that's going on. What I'm hearing is there's virtually no chance that anything crypto related, other than potentially what's in the infrastructure bill, is going to pass Congress. It's just so divided, and it's just not a priority. And so there's a lot of lip service being paid to needing to have Congress clarify these things. And very likely Congress is not going to clarify it, and not going to clarify it for the next couple of years, probably until there's another election. And if there's a clear leader and the issue rises to the top among all the competing priorities for Congress, then you'll probably see some action being taken. But I mean, for those who are not Americans or who don't pay attention to politics, the U.S. Senate is divided literally 50-50. And the Democrats control the committee chairman and set the agenda. But there's a power sharing agreement that's been in place with the Republicans. So every single committee is 50-50, right? When it's literally that equally divided, it's hard to get things done. And most of what gets done in the U.S. Senate, much of what gets done in the U.S. Senate has to get done with a 60-vote majority. So you've got to peel off, if you're a Democrat, you've got to peel off 10 Republicans to vote with you in order to get a lot of things passed. And that's just not happening. And so the chance of this, of any major congressional action happening is very slim. Where you see it happening is it gets, stuck into the budget reconciliation process, where it only needs 50% to pass. And that's why this infrastructure piece got snuck in at the last moment. It got snuck into a budget bill.
Now, do you think, though, there might be some catalyst, and maybe it's because capital is leaving the United States, or businesses are leaving the United States, that would force the hand of these members of Congress, or it may not, unless it's something black swan event type thing? I don't know.
Who knows? I've stopped trying to, call shots from the peanut gallery in Washington, because nobody knows. Even the people on the ground just don't really know. The only people who matter in Congress are the leaders that set the agenda, and there are only two of those. And crypto's just, they just don't even talk about it right now. So I think the chance of anything happening anytime soon is really indeed pretty slim. That's both good and bad, right? We don't get the things we want, but we also don't get the things we don't want.
Sure. Now we'll wrap it up on this last question here. Obviously, China just banned Bitcoin for the 1,000th or millionth time. We saw earlier this year they banned Bitcoin mining, the miners' move, which I think is a great thing. And we're seeing kind of a Bitcoin mining boom in the United States. What are your thoughts on that? Are you seeing Bitcoin miners in Wyoming?
Oh gosh, yes. Yeah. Yeah. Well, we just had Wyoming Hackathon last week, and there were, a whole lot of miners. There was a whole mining unit that happened at Wyoming Hackathon. And I must say, the University of Wyoming is now the first Division I university to run a mining pool, thanks to Marshall Long and his team of folks at Bitcoin Impact. They are teaching university students how to manage the equipment. And that, this is the first time I was there for the unveiling of all of this, and I got my hands literally dirty. I set up a miner, a used one, right? Dusty, loud, and has had all kinds of issues, had to be cleaned. Marshall actually on purpose brought some that were going to have issues because he wanted the students to learn. One of them had the fan on backwards, that kind of thing. And of course, within the first 10 minutes of turning them all on, a couple of breakers get flipped, right? And this is all by design, right? This is being done with electrical engineering students. And so it was a teaching moment for sure. So you usually don't have that number of problems, but I was really impressed with how skills intensive that is. And I just had no idea how much maintenance Bitcoin miners, the rigs, each one of them requires. They do fail, and you got to go in and, physically clean them out and, find out what's wrong. And if the circuit board fried, replace it, et cetera. And so there's a lot of university level skill that goes into operating those Bitcoin mines. And there's a gigantic lack of people who have those skills. And so what Marshall and his team, and then BitDeer also, Jihan Wu's BitDeer also donated equipment, and they're designing programs and a club to help train people to do exactly this, people with especially electrical engineering backgrounds. So that was fascinating. But beyond that, there's a lot going on in Wyoming in mining. Natural gas flaring is happening all over the place. Wyoming being one of the most energy intensive states. It's not like Texas where the energy is cheap. Wyoming power is not yet price competitive enough because of some issues with the way the transmission costs. Wyoming is a vast state, and there are huge transmission costs, and they are spread across the grid. And that makes the power for those who want to just set up next to the power plant, they've got to pay their portion of these huge transmission infrastructures, and it makes the power uneconomic. But the select committee is really working on this because Wyoming is an energy intensive state. And there are huge parts of our infrastructure that are where the markets are really in decline. In some cases, it's natural gas, but it's also coal. I know coal in some cases is viewed as a 4-letter word, but Wyoming coal is the cleanest coal, and there's a lot of technology going into carbon recapture that miners are working with, because if they have, for example, a carbon neutral pledge, then they're not necessarily going to stay away from coal as long as they can recapture it. And there's a lot of new mining exploration going on in Wyoming with coal bed methane. And what I find so interesting about all of this is that, frankly, the miners are actually sopping up things like vented methane gas or coal bed methane that create environmental challenges. And so it's carbon negative if you look at it the right way, because the miners are coming in, the Bitcoin miners are coming in and preventing those environmental issues from getting worse, or in the case of the vented methane, they're preventing the venting from happening in the first place. So right. if we really looked at it the right way, we would see that those particular types of mining operations are actually carbon negative. But I've now, at the extent of my knowledge, all I can say is there were miners all over the place that had come to Wyoming specifically to look at this. And it is in part because the global miners have had to go elsewhere outside of China. And yes, the price of power that they are consuming is going up relative to what it would have been in China, but they are in more stable regimes and making longer term commitments to base power consumption. And that is a wonderful thing. And boy, Wyoming is welcoming them as best as possible.
That's exciting. Well, Caitlin, it is always a pleasure chatting with you. And like I said at the beginning of the video, you are a wealth of information. So thank you for joining me today. And I can't wait to hear the announcement that you're going to make when you guys have completed your work with the Fed.
Thank you. I appreciate it. Thanks for having me on again. We'll see you again soon.